The market has been very mixed over the last 5 days, and one thing we continue to say is that many companies are trading at significant valuations, at least in comparison to their own 5-year average. But today we want to identify a company that looks to be very well valued, and that is Merck Co, as we can see based on the color and the forward valuation of 8.42. But not only that, it also offers a very strong starting yield near the 4% point. So is this now a company that is a must buy, especially for those that love dividends? Now we'll understand why it's down around 35% over the last year, and if this is one we should really add at its 52-week low, and the answer straight away from both Wall Street and Seeking Alpha is a resounding yes, where they both see this as a buy rating. And something we don't see that often on this channel is valuation A, growth A+, profitability A+, making it one for serious consideration, and one we do believe you should tune in for the rest of the episode. Now, over the last 10 years, this is a company that has unfortunately underperformed the S&P, up only 42%, and as we want to reiterate today, they currently offer a starting yield of 3.9%. So is this possibly a golden opportunity in what is an already overinflated market? Let's first look at their latest earnings, which was just from a few weeks ago, where in fact we see the company's share plunge as they pause their vaccine shipments in China, which has ultimately led to their 2025 outlook not looking that strong, and in fact falling short of what Wall Street themselves wanted to see. First, let's dive into those headline figures that we always want to see and how they compare against the analysts. That is the earnings per share as well as their revenue, and we can note here a nice beat on EPS, 172, market wanted 162, revenue itself 15.62, market wanted 15.49, so we are looking at a company that has had a double beat, which straight away is always nice to see. In terms of their bottom line net income, well, they did report 3.74 billion for the quarter, which is very impressive when we do compare that to the loss they suffered in the same quarter last year at 1.23 billion. Then we want to take you to the reason why this company has suffered, at least after those earnings. They anticipate now their 2025 sales on the top line to be in the region of 64 to 65.6 billion, which is quite some way away, lower than what the market wanted to see at 67.31, and we can see the main factor for this drop is that the company said the sales range reflects a decision to halt their shipments of Gardasil into China beginning in February and going through at least mid-2025, and we need to be wary that they say at least mid-2025, as this is something that actually could be prolonged further than they originally anticipate and will ultimately again hurt that top line revenue. Now, a bit of context for this vaccine: it says here that it prevents cancer from HPV, the most commonly sexually transmitted infection in the US, and why this is very important to the company, because as we can see here, investors have been unsettled over the last year by trouble with their sales of the blockbuster shot in China, and this country makes up the majority of the product's international revenue. So if we're seeing now one segment of their revenue being hit hard, it is a question now, how much will this affect their revenue, how long will this continue, and all of this uncertainty is what typically drives investors to get very worried and ultimately lead to share price drops, something that we have seen in fact for quite some time around Merck Co, but we can maybe potentially think this could be a great opportunity. And finally here, the lower end of their revenue guidance assumes no further shipments in China and less than 1 billion sales at the high end, which could mean here that they are potentially looking at lowering their guidance more than what they anticipate, and we could potentially see them beat it quite substantially. Conclusion to take from this is that a lot of this right now is fairly unknown. So if we just take a step back and look at their earnings history over the last 4 quarters, they have either been in line or outperformed, giving them a 100% track record. Love to see that. And over the next 4 quarters, all of 2025, they expect 3 of them in fact to be positive, 75%, and we like the fact that at the back end of 2025, the last 2 quarters, they're anticipating strong double-digit growth. Remember, this is to the earnings per share comparative, and right now their earnings per share for this full year at just under $9 means that this company, as we showed you earlier, is trading at a forward valuation of 9.3, so no surprises where we get an A on the valuation. What this ultimately means, the sector trading at just over 19. Right now, if you're buying this company, you are getting a 51% discount to the overall sector, but always key to understand, just because a company trades at a discount doesn't necessarily mean it is a strong buy. There could be reasons, maybe they lack in growth, maybe they're not that profitable in comparison to other sector metrics, and this is what we need to continue to investigate. But one thing we also like, when you compare it to Merck Co's 5-year average of 18.2, right now it also sits 49% below, and pretty much in agreement for the vast majority of valuation metrics, this company is looking severely undervalued. Great to see then on the growth, they get an A+. Year-on-year revenue just under 7%, not far off the sector median, although a little bit away from their 5-year average of 11.2. Over the next 12 months, they anticipate around 5.2, a little bit lower than the sector median, also a little bit lower than their 5-year average of 6.11, but we quite like the fact the earnings per share over the next 3 to 5 years is anticipated to outperform the sector, 16 versus 10.6, and just a little bit lower than their own historical data of 16.8. So a company right now expected to grow faster than the sector on the EPS metric over the next 3 to 5 years, but trading significantly lower than the sector valuation. Profitability, very impressive with an A+. Gross margin, 81%, a lot better than the sector at 58%, a lot better than their own 5-year of 73%, and bottom line, 27%, a lot better than the sector, burning through cash, -4%, a lot better than their own 5-year average of 18%. So this is telling us right now Merck Co are improving on their profitability. We're seeing quite a lot of efficiencies, especially against their own 5-year metrics. And in terms of cash from operations, they generate a significant amount, over $18 billion. In comparison, sector again burning through cash, -14 million, but also a lot higher than their own 5-year of 14.84. Lots of things we do like about this company. Now, what about the underlying metrics? Firstly, they get a very safe dividend score of 90. Love to see that, especially for a company yielding near the 4% point. 2 severe undervaluation signals, which we will cover today, and they did increase the dividend last November around 5.2%, slightly above the inflationary rate. Now, the dividend safety score was just reaffirmed yesterday at very safe, meaning a dividend cut for this company is highly unlikely. And if we get to the recession metrics, how they performed in the 07-09 recession, they did in fact maintain the dividend, didn't increase it, didn't cut it. They had above average growth, -4%, S&P itself, -12%, and they pretty much had a near return against the S&P, -57%, S&P itself, -55%. Now, dividend growth, 5%, not too bad last November, 7%, nice to see, well above inflation, but over the last 20 years at the 4% rate, pretty much increasing it on a year-on-year basis, keeping up in line. In terms of number of years, well, they have been increasing the dividend over the last 13, whilst paying a dividend for the last 54 years without a reduction. Now we want to take a look at their valuation, where we do get that undervaluation signal based on the forward P, but do bear in mind that we're not looking at this model in isolation. We're going to run it through our own process shortly. Blue tunnel is the expected fair price. Right now, we see this company at a massive disparity against the lower end of here, which signals severe undervaluation, something that is also reconfirmed when we look at dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year. In fact, as of today's date, you are getting the highest yield on this company over the last 5 years, another severe signal, and the same to be said on the forward P, trading significantly lower than their own 5-year of 13.5, and as we highlighted, the sector as a whole is trading at a much higher rate, thereby meaning Merck Co right now at a discount. In terms of the first metric, we are looking at the free cash flow payout. As always, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want. Now, very inconsistent, but nice to see on a trailing 12-month and expected over the next 12 months for this to come down to in the 35% region, meaning we should be expecting a fairly attractive increase to the dividend this November. Free cash flow per share is something we want to see consistent increases over the longer term. Pretty inconsistent in my opinion, and over the next 12 months it is expected to increase quite significantly, but just something to bear in mind with the company and their figures. And we also noted inconsistency on their sales growth. Whilst we want 3 to 7%, we can see on a year-on-year basis there is no real consistency, but nice to see 2024 was a fairly strong year at the 7% point. In terms of numericals though, they have been growing their revenue over the last 10 years As always, have realistic expectations with companies and the industries they operate, and whilst they have been returning excess cash through those share buybacks, what we have noticed, it has started to slow down, at least from 2020, where in fact they haven't done any share buybacks. Just something we want to point out, as we do see this as a nice bonus on top of the dividend and those increases. Now, ROIC is one of the metrics I love to look at, one of my favorite, where I want 10% or more. Give me faith, management are able to effectively allocate their capital. Not only is it well above 10%, but it has been increasing over the last 10 years. Very strong sign, sitting now at 28%. And then we get to the margins, which is very good to see as well, not only above 12%, but efficiencies. We mentioned this word earlier on, and it's one of our identifiers of a high quality company. Increase their top line, but very important to also increase their margins, going from 22% to 35%, and no issues with the free cash flow, well above 5% on a year-on-year basis. We then end on the net debt to EBITDA, where we want below 3. Remember, this does correlate to balance sheet strength, dividend safety, and the numbers you see below, number of years it would take the company to pay off all of their debt net of cash on hand. 0.88 on a trailing 12 month, 0.77 over the next 12 months. Very strong balance sheet. We will show you this later on as well, but also no surprises, the dividend does look to be safe. Now, we also want to compare their performance against others in the industry. In pharma, we have Novartis, AstraZeneca, as well as others I'm sure you've heard of. In terms of total return, including dividends reinvested, they have been the worst performing, negative 33%. When we expand to over the last 5 years, not great, around 24%, although the majority of companies here also have a similar fate. And over the last 10 years, we can see up 103%, pretty much doubling the original money you did invest 10 years ago. Not too great. Ideally, you do want to see a bit more, but as we always say, past performance is not an indicator of the future. Now, we also want to just highlight here the underperformance against the S&P, both in the last year, both in the last 5 years, as well as the last 10, because ultimately, if you are picking a individual company, you want it at a bare minimum to either be in line with the S&P or in fact outperform. Definitely considerations that do need to be made. In terms of institutions, 76% ownership, 14 billion worth of sales over the last year. We're talking about all of 2024, but a lot more buying in fact the same time frame. And one thing we also note, over the most recent quarter, Q4, with the data, they were buying a lot more than they were selling. So clearly, institutions very bullish on Merck Co. In terms of insider ownership, 0.09%, we don't get much buying or in fact selling during the last year. We can show you, as always, for transparency, who's bought and who's sold. Remember though, insider selling, we don't typically believe this to be a bearish signal. They sell for many reasons, personal and financial. Most recent, just a few weeks ago, an insider sold over 2,000 shares, but we also noticed on the same day a director bought 2,833. Information is here if you do want to use it in your own investment thesis. Now, we already covered their top line revenue. As we did say, it has been increasing, although inconsistently over the last 10 years. But what we want to identify, bottom line, what is the story to be told? And actually, we do get a little bit of consistency. It has been increasing over the last 10, although we do notice a very poor year in terms of net income in 2023. But overall, it has gone from 4.4 billion in 2015, now sitting at 17.1 in December 2024 accounts. Very nice, but again, just factor in a little bit of inconsistency, and that is why we always like to use a margin of safety in our valuation. Then, as a quick health check, total cash versus total debt, we actually notice cash very inconsistent, which is very typical. There is no real element of consistency in these metrics, but it's gone from 13.4 billion in 2015 to just under 15 in the latest quarter. And as always, we do like to compare this to their total debt numerically and directionally, because one number here in isolation won't tell us anything, and it has been increasing over the period, going from 26 billion to now sitting at 38. But as we saw, net debt to EBITDA does look very good. It won't really take this company that long to pay off all of their debt, and as we saw, dividend does also look to be very safe. Finally, we just want to highlight the cash this company does generate from operations, which has been increasing over the period. Again, do note the inconsistency, going from 8 billion in 2014 on a trailing 12-month to 18.3. Now, before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We drop one copy every single Monday morning, completely free to your inbox, where we cover severely undervalued stocks, as well as what's gone on in the market over the last few days. So click below, you can sign up, as well as getting access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 32 stocks stocks that Wall Street themselves believe have the most upside right now in the S&P 500, so click below, you can sign up and read straight away. This then takes us on to the valuation, where our intrinsic price comes to $119, which is just the average of these three models that you see. We'll run through the inputs and the outputs, the first one being the multiples valuation. Companies in a similar sector and size, their average P multiplied by the EPS of Merck Co to give us our first intrinsic value of $124, showing undervaluation. But as always, we don't look at any one model in pure isolation. In terms of the next model, dividend discount, we can see fairly consistent in the growth of them, 5.84 over the period. We've gone more conservative at 5.25, another undervaluation signal. And then we have the DCF model, free cash flow year on year. We have the growth rate at 10%, roughly in line with analyst targets. Discount rate to get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get here our third undervaluation signal, and the average comes to 119. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Merck Co or any others. But we're not done just there, as we always apply a 10% margin of safety to start off with. Execute on that if it meets these three golden criteria: wide moat, strong financial metrics, good forward-looking data. A buy if you believe that, up to $107. Then we keep going till it's near the current trading price. And right now for Merck Co, you are getting a near 30% MOS. Wall Street themselves, in fact, as well as seeking alpha, fairly bullish with their buy ratings. Wall Street see this at $116 over the next year, translating to 38% upside. Now, this company does pay a yield near 4%. It does have a very nice margin of safety, fairly attractive upside as well. But give us your thoughts. Is Merck Co one now, after the massive drop we have seen, a contender for a very strong buy? Or in fact, is this one you're looking to hold, or maybe not considering or selling? Let us know below. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we do cover our weekly buys and sells, and we have been making some movements given the volatility over the last week. As always, have a great day, and we'll see you all in the next one.